bond investors are focusing their attention on the short end of the curve with demand driven by coupon reinvestment. Now, for the T-bills, market analysts say the bullish run will be sustained despite today's announcement of the MPR rate hike of 100 basis points to 17.5%. Seun Wameh, a fixed income trader at Citibank, joins me now for more market updates. Seun, thank you so much. Pleasure to have you on the show today.
Thank you.
Let's start with our big story, of course, the announcement by the Monetary Policy Committee today, 100 basis points hike to 17.5%. Analysts that were spoken to in the run-up to the outcome had said 50 basis points. Some even said no movement because in a political cycle, etc. But 100 basis points. So was that in line with what you were expecting, and what is the market reaction?
I think I would join the analyst that said no hike. Or 50 basis points, really. It was a surprise to me, the 100 bips hike. I think most people were expecting that they just hold rates at this MPC meeting, or they just hike, maybe about 50 bips at most. But 100 bips, I think most investors will be surprised.
So what direction can we expect the markets to go from here in terms of rate movements?
Well, normally you tend to see yield starts rising on bonds and T-bills. But, I mean, the market will just wait to see what happens. We have a couple of events coming up. We have a T-bill auction tomorrow. There could probably be a CRR debit this week, and we have a bond auction on Monday. So really, we expect yields to start rising up, but the magnitude will depend on what happens at these auctions. Yeah.
That leads me to my next question. I wanted you to weigh in on this. The argument by some analysts that look, the rate signal from the MPC runs contrary to current market rates. 1-year T-bills around 8%, the 90-day 2%. We did see that massive drop on those short on those short-dated T-bills. But what do you think? Do you agree? Is that your sentiment too?
Well, I think the reason for that is because of the liquidity you have, the cash balances in the money market, pretty large, really. Sometimes you can have a lag in between when we have this cash, in the money market and when the central bank moves it up. So I view this as really temporary. It runs against everything to see your MPR rate at 17.5% and your TB rate at 2%. But I think this is temporary, really.
But can we expect it to happen fast, the mop up and the convergence?
I think so. I don't think this is going to last, and I think very soon those issues will start rising up.
So what can we expect for the rest of the week in terms of liquidity levels at the market, rates, etc.?
Well, I think liquidity level will reduce. The central bank, just hiked the rates, and they sounded pretty hawkish. They're going to come and mop up liquidity in the money markets, really. Yeah, so liquidity will reduce.
So that it all makes sense.
Yeah, so that it all makes sense. Market probably trades cautiously, trying to adjust to the new MPR rates. Like I said, I think it was a shock for most people, really. So between now and next week, it's just them trying to adjust, trying to find new levels. But over time, I think the trend is for rates to keep rising, and central bank really tighten the noose on liquidity.
I'd like to get your thoughts on the corporate bond market, what we can expect this year for corporates and looking to raise cash. And of course, we know that the government is going to come heavy on the domestic borrowing side this year. What can we expect?
Well, I mean, like you said, they're going to tee off the sovereign curve, and it's going to be a little bit challenging, really, compared to what we saw in 2022. Because the yields on bonds, if they keep rising, and for corporates to come and raise bonds in the market, there's going to be a spread. There's going to be a liquidities. They're going to spread
what about commercial paper, CPs?
A credit. Yes, they can come to the market, but there will always be a spread compared to the corporate to the sovereign paper. So really, I think it's going to be more challenging, compared to what we saw in 2022.